afternoon, financial professionals. My name is John Florence. I'm Senior Vice President of Marketing here at E4 Insurance Services, welcoming you once again to another episode of The Brew, where we build relationships every Wednesday. On today's Brew, we welcome E4 Insurance Services Senior Vice President of Disability Insurance, Brady Serold, and Vice President for Institutional Accounts, Steve Walker, for a special 30-minute Brewcast. Today, Brady and Steve will be focusing on annual benefits enrollment by providing ideas on how to fill the gaps on disability income and group benefits on a personal level, but also supersizing those ideas at the employer level. As we move through the recording today, please feel free to use the chat box to share your thoughts or ask any questions. Also, all attendees are in the drawing for a CE voucher and Starbucks gift card, and we will be announcing the winner at the end of the program. So, Brady and Steve, welcome back to The Brew. We had a little bit of time to spend together last week, and I'm glad to be able to do that with you, and excited to hear what you're going to share with us today related to what's going on. And Steve, let's begin with you. We know that October is the start of the open enrollment season for employees. It's also the start of open season and hunting, I think. But unlike the birds and the woodland creatures that are all scurrying for shelter, open enrollment is something different. And it's a time that I think for most employed individuals are looking to renew and review their benefits and make benefit decisions for the 2024 year, both exciting and stressful at the same time. So let's start talking about that. What is it that E4 Insurance Services can do to help our advisors and benefits consultants during this renewal season? Let's start with you, Steve.
Yeah. I mean, it's a, like you mentioned, John, it's a busy time of year for anybody that's in the benefits world. Between now and first of the year is when a lot of group benefits plans will be renewing. There's obviously some different dates, but this is a lot of the renewal period coming up here very soon. So when it comes to actually helping with and providing group benefits, that's not necessarily the lane that we want to play in and assist with, but really where we can assist, help, and really enhance an advisor's benefit practice is really in that executive benefit space. And when you say executive benefits, and it's not just for the owners, the executives, the C-suite, but it's really for those critical employees to make sure that everybody's not paid the same. And that's one of the questions we ask, bring up to our benefits advisors, is asking those business owners and decision makers is, does every employee on your team make the same on their W-2? And the answer is inevitably no. They're paid differently, but more times than not, the benefits are the same across the board. And how that works, whether it's life insurance, disability, 401k, when you get into those high earners, proportionally, those benefits aren't as meaningful the more and more benefits that you're making. So anybody that's been on Brew in the past may have heard this phrase before. So we can help provide asymmetrical benefits for asymmetrical contributors to your company. And that's really a solution to say, hey, in this world that we're in, it's not all about comp. People are always after the top talent, no matter what your industry is. And again, if it's just strictly comp, somebody else can come in and give them a 5-10% raise, whatever that equates to dollar wise. And if there's not something extra hanging out there to really make it meaningful, that might be all it takes to get somebody over. So really, as we talk today with Brady and I, that's what we're going to focus on, is enhancing, and I like the word you use, supersizing those benefits for those key contributors to an organization.
Yeah. In executive benefits, traditional benefits planning, what's the difference here? I mean, it seems like a lot of these words kind of become a little bit of a word soup. So how are you breaking out those differences? And I think you kind of were addressing that a little bit when you mentioned asymmetrical benefits for what was the phrase?
Asymmetrical benefits for asymmetrical contributors.
Yeah. And is that what you're talking about?
The more somebody contributes to the bottom line or the value of the business, again, you can raise their pay, raise their compensation, but again, it may or may not keep them there long term, especially if there's not necessarily ownership percentage for that individual. So again, adding additional carrots on top, whether it's additional benefits, deferred compensation, really it's a vast array. If you think of it's almost like a blank canvas, and as advisors, we can be the artists that are really designing those benefits to make an employer attractive for those key employees.
Yeah.
And then, John, another part just to add to touch base with John or with Steve is, those benefits, they're the same type of products that individuals can go purchase on most part from an individual basis. But, when we move it to the employer side and call it executive benefits, it's a fancy term. But again, there's some concessions, whether that's underwriting concessions, rate concessions. So there's some value from that perspective to do it on the employer level. But I mean, truly, these aren't your normal employee benefit, group life, group LTD, long-term, 401k. These are plans on top of those plans, just sold at a group level.
Yeah, so we're really making a distinction between individuals on the one hand and perhaps employers or business owners. So for the advisors and benefits people that are watching this today, it's kind of sorting out the sheep from the goats, if you will, on this topic and finding the various solutions that apply to each of those different subgroups. Let's talk about some of those solutions. Brady, bring you into the conversation here. What are some of the solutions that our advisors can help business owners with specifically?
Yeah, so when you look at the business owner side, I mean, last week in Fargo, we talked a little bit about, overhead expense if you're a small business owner or maybe you have 3 or 4 partners in, like, say, an accounting firm or a dental practice or a surgery practice. You look at the fixed expenses that can be reimbursed in the event they get sick or hurt and can't work. And then there's the disability buyout side. So, when you have a partner, most people fund for buy-sell disability or for life disability, but they have a provision in their agreement that says, well, what happens if you become disabled? And most people don't really think about that, whether it's the wording or the funding mechanism. So those are a couple things we can assist with. And then just the normal adding onto their group LTD, is 60% really 60%? And, to go to that asymmetrical part, the higher you get in earnings, 60% is probably not there, because of caps, benefit maximums on the group plan, covered compensation. Again, most people have bonuses and commissions, and those typically aren't covered under group plans. So, those are your top earners, and when they look at it and they come out and say, "Oh yeah, I have 60%." Well, do you? And that's when, what we can do is put that out there and say, no, Mr. Executive or Miss Executive, you have 32%. The receptionist has 60, the accountant has 60, and you have 32. Is that fair? Do you want to look at something, solutions to provide those gaps?
Yeah. So let's talk about maybe some of the specific examples that maybe one or both of you can share, so our advisors and listeners can kind of get an idea of the kinds of cases you're working on.
Yeah, like Steve, we talked about the one. I think you put together a sample to show, a case that we recently worked on that, came about just as a conversation, of holes in their existing benefits and, transformed into multiple opportunities.
Yeah, absolutely. And this is an opportunity that Brady mentioned really started probably a year and a half ago. In the conversation, the advisor had some key person life insurance within this group. It's a law firm. You can see on the screen here, kind of a company profile, 13 partners, an additional 5 associate attorneys that aren't partners yet. So they had some key person life insurance in place. So again, protecting the company in the event of a death of one of those partners to help facilitate and replacing and a buyout of that. And really the conversation continued on. Again, this is a great advisor that isn't just a one and done. It's having those continual conversations. So really got to the realization that the key person insurance was no longer adequate. They needed to have additional. They also realized, as you can see in the third bullet here, with those income levels, some of these are high income earners. Majority of them are high income earners, excuse me. The partners' incomes aren't properly protected. And we'll get into that here in the coming pages. So really it's a two-pronged approach, and really even beyond that. But as we had that discussion with the controller at the company, really just doing a deep dive and really hitting on two key components. The first one is protecting the partner's income. And again, that was a new one that doesn't fall under the traditional key person life insurance that they already had at least a portion in place. But kind of getting onto the why. So starting with this protecting the partner's income, wanting to make sure, and again, we took out all the company details, just put your company. But if one of the partners becomes sick or hurt and unable to work, their income, again, it's a 60% long-term disability benefit, but it has a cap of $15,000 per month. So again, for those high income earners, partners in a law firm, $15,000 cap is not 60% of their income. So again, we can look in this bullet point right here. The company can elect to only offer this benefit to the partners of the firm, which again, if you think of traditional employee benefits, your group health, your group long-term and short-term disability, group dental, this, that, and the other, that's going to be offered to everybody. Now, in this space, when we look at more of an executive benefit or executive carve-out, you can legally discriminate as long as you've got a clearly defined class of employees. So again, for those partners, that's a clearly defined class that they can offer above and beyond disability income. So as we continue to move forward with this bullet point right here for your employee benefits producers, we can add this without underwriting on a guaranteed standard issue program. And again, that's with the benefit of being in a group platform with the number of lives that we're looking at. The insurance companies realize partners, and again, it depends upon the industry, the risk of them becoming permanently disabled, again, it's a risk reward for the insurance company as well. But they understand that they want to write the business, so we can get guaranteed standard issue. Each company is a little bit different on the enrollment, but again, we no longer have to worry about individuals or these key people having to get approved for long-term disability insurance in this case. And as we move down here, again, with the breadth of being independent and having multiple carriers to go with, a lot of kudos goes to Brady as well. He's got the relationships with these disability carriers and can go to bat for our advisors. We were actually able to secure at least 4 or 5 good offers, and really came down to, on this summary here, showing what the two are. And again, there was a separate Word document for this company, but really high level, the top 2 options, Mass Mutual said they would offer, again, additional coverage up to a $20,000 per month cap. And we had a number of those executives that would qualify for that additional $20,000. Principal said they would not go quite that high, but still $17,500. And then it just comes down to a financial decision. Again, you see Mass Mutual about $7,800 a month premium for that $20,000 cap, where Principal is a little under $4,500 a month for a premium with a $17,500 cap. So for, again, those that are going to benefit for that additional $2,500 a month, does it work? Is it worth it? The partners are actually meeting this coming Monday. My assumption, they'll probably move forward with Principal, just with the financial difference being only $2,500 a month in benefit, but again, over a $3,000 a month premium difference ongoing. So, this was a great solution. Brady, I'm not sure if you've got anything in particular to add on top of that, but really just a great solution for one of our advisors' clients.
Yeah, no, again, in the enrollment part, I think that's the one thing an advisor would want to know. What does it look like if you enroll it? So it's, in this case, it's basically we get a pre-filled census, and we do the applications, and it'll be an online enrollment. It won't be a census enrollment because of the type of group, but that is available on non-medical and non-attorney groups. or do they just enroll straight from an employer census? So this is an actual online enrollment. It takes about 5 minutes, but we pre-fill most of the information. They have to be actively at work. And they ask tobacco and other disability coverage. That's really the only questions you're asked on it. Versus, if you go through full underwriting, you're asked every question under the sun. You have to give 2 years tax returns, all supporting schedules. You may have to visit the paramed examiner and use the cup and get stabbed by a needle and step on a scale. Again, this doesn't ask you, have you ever been treated for cancer? Are you a diabetic? Do you have sleep apnea? What's your build? It asks nothing like that. So it's really actively at work and other coverage in the tobacco portion, and you get your coverage.
So a couple of questions. Steve, you mentioned that this was for a 15 partner law firm, which I'm guessing, maybe their entire employee base might be somewhere between, call it, 30 to maybe 50 total employees overall. But how small can a company be and actually put together something like this guaranteed standard issue program that you're talking about? A lot of our advisors aren't necessarily working with, even though we might consider 30 employees to be small, there's a lot of people that are definitely smaller businesses that might even have fewer than 10 employees. Could it work for an outfit like that?
Brady, I'll let you start on the disability side. So I know the answer, but you're gonna explain a lot more eloquently, I feel.
Yeah, I mean, I think really, can it, John? Yes. I mean, are there professional groups that are under their 10 lives or under? I mean, really the key is looking at spread of risk, and they really underwrite this like a group product. So the more lives that are available, the better the types of offers you can get. So can you work on smaller groups? Sure. I mean, we put it in before on a small law firm where there were only 3 partners and 2 associates and 5 employees, and we put it in on the partners and the associates. That's your 5. Again, it really comes down to incomes because they look at income, gender mix, and ages, and that's kind of how they take a look. So yeah, there are some small companies that could definitely be a fit, especially if you're in the professional side: attorneys, architects, CPAs, engineers. Those groups that are small, and in being a professional group, they're primarily white collar. So they would definitely have opportunities there. But they start at five lives guarantee issue. That's kind of where the programs start, considering to be able to offer on the DI side is at 5.
Yeah, that's what I was going to touch on as well, is really with the benefit of that guaranteed standard issue, that 5 participants really, like Brady said, kicks that into gear where the underwriting is essentially nothing. Once they hit the age and age mix, gender mix, what they're doing. But to get that guaranteed standard issue on disability is going to be 5. Life insurance, again, sometimes 5, more times than not, it's going to be 10 to 15. A lot of times 10 or more, we can get some guaranteed issue life insurance. But at the same breath, even if your company is small enough to where you can't get that number of lives to be guaranteed issue, the need is still there. Even a 2-person shop, 3-person shop, when their incomes are there, they might not be able to get the guaranteed issue. They might have to go through the underwriting process, but again, the need is still there for those clients. So don't forget about that for our advisors as well.
Yeah, and so Brady, you've had a lot of experience on the underwriting side of this. For somebody like me who's kind of new to these kinds of ideas, the math behind it is really simply, like you say, we're spreading the risk out over larger numbers of people, and that's what can make the availability of these guaranteed standard issue programs is, from the actuarial side, it's just spreading it over large numbers, right?
Correct. It's spreading it over numbers, and it's a selection issue. So a lot of times when you're looking at these executive benefit type plans, the decision to buy the coverage is not necessarily made for by the employee. It's made for by the employer on behalf of the employee. So you look at claim experience for individuals who aren't really the payer of this product. Again, it's kind of the utilization side. Hey, if I have something and I'm paying for it myself and I chose to buy it, your propensity to use it is higher.
That's a really great example. Any other sort of cases that you guys have been working on together that would be worthwhile to share with our audience? Other examples?
There is, and really before we move on to that, one other thing we touched on, again, in reality for that guaranteed standard issue, one of the brews we did not too long ago was don't stop with just the first opportunity, dig and dig and dig. So we talked about really the second thing with this law firm is how do we protect in case that buyout is triggered. So again, not necessarily executive benefits, but along those lines, again, with that key person, what happens if the partner becomes permanently disabled and can't work? What happens if they pass away? You can, again, with that buyout, you can either pay 100% of that buyout plus the lost opportunity of the cash if they just go cash from the business. They can pay 100% plus interest of what that buyout is if they go get a loan, or the beauty of insurance, having that leverage to pay pennies on the dollar for insurance. So in this same law firm, we're looking at disability buyout. So again, a guaranteed issue program, looking at a $300,000 lump sum to help facilitate a portion of that buyout. On the life insurance, we're looking at about $2 million of needs. So guaranteed issue with this number of lives, we're able to get a little over $1 million on each partner, another $200,000 on each associate, and then additional $1 million of underwritten product as well. So before we move on to the another opportunity, that was just another nice win within that same executive benefits conversation we were having.
Well, and Steve brought me in on the case and we talked about it, and the key part was the guarantee issue disability because the partners wanted more income protection, and they're also on the life insurance side. They were looking at from a buyout standpoint. That was the initial part of the conversation a year and a half ago, and when we were in the conversation, we just asked the question. So, how is the amount determined if they die? How much they owe? And they told us the formula. And I asked the simple question. I go, so what if they get disabled? And they go, that's the same formula. I'm like, okay, well, here's a program. So it kind of led to that other option that they didn't even know was available out there. So, whether they choose to, cover that risk or not, again, all we're doing is providing solutions to the employer that they didn't know existed before.
Go back to your other question, John, another story, another case study, if you will, is one we actually just got the green light on this morning. Brady and I were working on a case, and that one actually started a little bit different. It didn't start in the executive benefits discussion, but it led into that. We've got an advisor that has an existing group that had disability insurance as an added benefit, so over and above the group that the company was paying for just on a one-off on their executive, not on the guaranteed issue space like we looked at for this last group. So they were looking to add an additional executive to that plan. It was a fully underwritten plan. There were discounts involved. However, when we started looking through that case and talking about the individual, and with Brady's extensive underwriting background,
he had some health issues. I mean, again, would have he had issues with underwriting? Possibly, but again, why put him through that? So we threw out that, the option, as Steve said, we just said, hey, Steve handed it over to me. I'm like, I did a little Google search on the company, saw that they had, 6 executives on their leadership team. And I go, have you ever thought about talking to him about this? No, what is it? I said, well, here's what it is. He goes, here's the census. They're interested. Okay. You go from a one-off thing to something different. And now we're installing that for a November 1st effective date.
This is what you guys mean when you talk about supersizing an opportunity.
Exactly. Yeah, that one started off as about, probably from a premium standpoint, probably on the individual, $2,000, $2,500 a year disability premium, if he could qualify, which again, to what Brady said, the chance of him of getting approved was very, very, very slim. So now again, we now have 6 individuals that are being added to the plan on a guaranteed issue basis. So, and every time they add an executive, they'll hop on the plan as well on the guaranteed issue platform as well. So really, it just goes to asking the question. In a not so good scenario, again, not anything that we were involved in. This was several years back, but I've got a group that I work with that the advisor had the group benefits plan. Again, the group itself had your typical long-term disability, 60% up to the monthly cap. They did have a lot of high income earners where 60% was not 60%. And one of those high income earners go out on disability. Actually, no, I believe they caught it before there was a claim. But another benefits advisor came in, talked to him about benefits, the executive benefits, and said, hey, your group has a cap of X. Your executive team is making significantly more. Have you looked at a guaranteed standard issue disability program to add asymmetrical benefits to your asymmetrical contributors? And it was a nice large account for this advisor, and they lost the entire account, the benefits, the commercial insurance, the whole gamut, because it was not brought up to that business owner. They're not all going to say yes, but at least as an advisor, being able to bring that to the attention, it's another tool in your tool belt to say, hey, have you looked at what executive benefits can look like? So it's another added retention tool for your clients, as well as a good door opener for new client opportunities.
Yeah, it's fascinating as we continue having these conversations about the kinds of planning that people can do. Now, I know that a lot of the advisors that watch our program have business owners and executives as their clients, but maybe they have not gone down the path of starting to have these conversations. And as you have shown, both of you have shown so well, there's just a tremendous amount of opportunity for value that you can bring to those businesses as an advisor. But for somebody maybe like me who hasn't really played in that space before, what is the key? What's the first question that you need to approach that executive or business owner to ask to kind of unlock the remainder of these opportunities? How would either or both of you go about initiating the very first conversation on this topic with them?
Yeah, well, I think, it starts with the conversation. So, I think, and this is a great time of year with it being open enrollment. So we're talking about the benefit enrollment side of it on the employee benefit advisor, but also your normal client. I mean, they get every, October or September, they have to fill out their forms. Do you want the life insurance? Do you want the voluntary benefits? And again, people don't really know. So I think that's an added service an advisor can provide to their key clients to say, hey, you started a new job or your benefits are changing. Let me take a look at it. And again, help evaluate what they have. Now, again, I think that conversation can go further if you're talking to one of the key people and say, hey, well, if you're the CFO and you have this problem, how many other people are at your same level? Especially then if there are maybe potential health issues. I mean, there's ways to get it less expensive with guarantee issue. So again, it can lead into that discussion from the personal side. But I think the biggest part is in understanding what plans they offer currently. So, and that could start as an individual, and each individual has the right to get their summary plan documents, and we can review them and, help you, navigate those. But again, then that can, I think, lead into the benefit side, at least from that key person. Because again, a lot of the advisors aren't in the employee benefit space.
Right.
So, and they're not going to get in the employee benefit space, and talking to a HR person isn't going to get them anywhere if they're not in control of the group benefits and know that sort of thing. So if they're not in there with the executive, it's tough to get to the HR side. But the benefit advisor kind of comes in on the HR side and maybe the key people and navigating it that way. So again, the normal advisor who has some key contacts and employers, just by understanding their own plan, can give you some tips to get in there and maybe talk about the executive plan, and then maybe turn into where Steve and have maybe one of their partners does all the commercial insurance. The next thing by getting in there and taking care of one of the key employees, and all of a sudden you got the entire account for your firm, and that other firm that fell asleep because they didn't talk about that is SOL.
Yeah. Steve, anything to add to that? How does an advisor initiate these conversations for somebody that hasn't made their bread and butter in this space before?
I think Brady nailed it. If you've got the benefits, it's just going deeper. Again, taking each relationship deeper and wider, showing where there's potential gaps. And like I said, not everybody's going to say yes the first time, but it's our job as advisors to bring up the potential loopholes. Second off, this executive benefits conversation, oftentimes it's not your typical benefits conversation with your HR head of HR. It's with that CFO, it's with that executive, it's with somebody that's going to really benefit from these types of offerings and really opening that door. So to Brady's point, I think what he hit on can't go overlooked. If you don't play in this space, don't try. Don't try to be an expert, I should say. If you've got an advisor in your firm, and several of our partners do, make that introduction. Hey, I've got a partner that specializes in executive benefits and taking care of those asymmetrical contributors within your organization. I really think it'd be valuable for you to sit down. If you don't have that individual, talk to myself or your RVP at E4. We're happy to be that partner with you and go alongside you to open those doors and to have those conversations. So really it starts with asking a question. Don't go in with a product or solution in mind. Do not lead with product. It's asking those questions. What are their goals? What are their concerns? And what are those gaps that we can fill?
Yeah, brilliant. And I think that's a great way to wrap up, unless either of you guys has anything additional that you'd like to add to the conversation. I would encourage any of the advisors that are watching this to please reach out to either Brady and or Steve, two guys who are really well versed and steeped in these areas and can kind of be your shepherd or guide as you're developing and covering these kinds of opportunities with your clients. Any last words, gentlemen?
No, happy hunting, I guess, right?
Yeah, it's hunting season, right? Well, thank you, everybody.
Yeah. I think, and one last thing to wrap up, last comment is just be consistent with your ask. Don't give up after one no, because again, like anything else in this business, you're going to get told no more than you get told yes. And again, if your clients know that you are in this space, they're going to come to you when the timing is right, or you're going to catch them at the right time. And as Brady mentioned, this is a great time to be having those conversations. So be consistent, find a partner, whether it's internally or somebody here at E4 to really shepherd you along your way.
Awesome. Thanks, guys, for participating today. Great to see you both back on the brew, and thanks for this valuable information today. So join us next week when we come back on the brew. We're going to be welcoming E4's managing partners, Dan Peterson and Brendan DeRowan, for a third quarter update. They'll be reviewing current industry's trends, reflecting on what's been happening here at E4 over the past year, past 9 months anyway, and our continued focus on providing consistent, positive advisor experiences in the area of asset protection. So thanks, guys, and we'll see you all next week on The Brew.